Part 1. I'm losing, what should I do? In this part of the book we meet some of the world's greatest investors in losing situations. These are situations we can all relate to. The investors have lost a lot of money and there is massive uncertainty and negativity surrounding their investments. They are faced with the need to make a crucial decision, to cut their positions or stick with them. And if they stay invested in a stock, should they invest more money? Through the rabbits I will show you the pitfalls you should try to avoid. Through the assassins and hunters I will demonstrate exactly what to do if you want a hope of salvaging the situation or indeed turning a loser into a winner. Chapter 1. The Rabbits, Caught in the Capital Impairment. The rabbits ended up being the least successful investors working for me. But you could never say they weren't prestigious. Many of them were celebrated figures in the city and on Wall Street. One occupied the top floor of a small skyscraper and had meeting rooms with breathtaking views over the city of London through floor-to-ceiling glass windows. A couple of large security guards greeted you before you even got to the marble-floored reception. Others had decades of experience and name recognition. Some were real housewives' favorites. They were always very likable and whenever I met them positively oozed success. However, like any investment legend, gaining access to them was easier said than done. For me, you could say it took $50 million. That was roughly the sum each of them ended up managing on behalf of my firm. As this chapter unfolds you will see why, in the end, I wished I had never met any of them. Jumping in. Let's look at some examples of these investors in action. You'll soon see what was particularly rabbit-like about their investing habits. Case study, Vike Communications. Vike Communications was a UK-based company that specialized in software that allowed users to make telephone calls and send text messages over the internet using their mobile phones, computers or normal landlines. Very big things were expected for this company when one investor started looking at it, not least because it basically meant that users could more or less make international phone calls for free. This seemed like a huge deal. Perhaps Vike was the next Skype. It could revolutionize global communications. The investor bought shares in Vike on October 31, 2007 at £2.10. As it happened, this would be more or less its peak price. When the stock started to fall shortly after his initial purchase he bought more. So far, so good. This is, after all, what you should do if you are sticking with a stock for the right reasons. Then it kept falling. The investor chose to stay invested, but he refused to put more money to work. Roll on 2.5 years to July 2, 2010. At that point the investor decided to sell his entire position, with the stock down 99% and trading at 2 pence. Assuming an annual average return for the stock market of 8% per annum, it would have taken this investor 60 years to make all my money back. He needed to produce a return of 9,900% to break even. Case study, Vostok Nafta. Vostok Nafta is an investment company listed on the Swedish stock exchange that invests in assets in the Commonwealth of Independent States, CIS, a loose association of some of the countries that used to make up the USSR. Its goal is to coordinate trade and security. As you might imagine, many of Vostok Nafta's investments have been in oil, gas and mining companies, both private and public. In the past this has led many European investors to purchase its shares as a means of expressing a positive view on commodities. It gave them a leveraged play on that theme. But more recently Vostok has diversified into consumer-focused companies and has significant investments in Russia's first and only credit card lending company, Tinkoff Credit Systems, as well as an Online classified ads company, Avito. The current Vostok really looks nothing like the old Vostok. It shows just how much things have changed in Russia and its neighboring countries in the past 20 years. It certainly no longer represents a pure leveraged play on commodities. On April 11, 2008, an investor bought shares in Vostok Nafta at €9.14. 5 months of unexpected underperformance later, and he was persuaded to finally sell at €3.95, realizing a loss of 57%. It is important to note that the only reason the shares were sold was because I was putting pressure on the investor to either buy more or to sell. The investor did not want to do anything but could not justify why. If I had not intervened, I am pretty sure he would still be holding the stock today. Assuming the stock reversed course and enjoyed the annual average return for the stock market of 8% per annum, it would take 11 years just to break even. Phrased differently, having lost 57% of the original capital invested, the reinvested capital would need to produce a return of 133% just to get back to the starting level of capital invested. Case study: Raymarine. Raymarine is a company that specializes in marine electronics, helping yacht owners kit out their yachts with radars, satellite TVs, fish finders, GPS gadgets, and various other communication devices and bits of equipment. An investor bought shares in the firm on May 31, 2007 at £4.27 per share. Roll on 23 months and the stock price had collapsed. The investor was still invested. He was still talking about what a great company it was, though he hadn't yet bought more shares. One of the reasons the investor put forward for doing nothing was that he was unable to buy more. The stock was too illiquid. Of course, that meant the chilling reverse might also prove true: it might be too illiquid to get out. In investment circles, this is a schoolboy error. You should never get into something that you cannot get out of in public markets. The investor also felt that enough money had already been invested. After pressuring him to do something, he eventually agreed, and managed to sell his entire position on April 15, 2009 at 17 pence per share. That was a loss of 96% on his original investment. Considering an annual average return for the stock market of 8% per annum, it would take 43 years to break even. He would need to produce a return of 2,463% to get back his original investment. What the rabbits did wrong. The rabbits often dug tunnels that were so deep, they never saw the light of day again. Why did they make this mistake so many times? The future may be made up of many factors, but where it truly lies is in the hearts and minds of men. Li Ka-shing. I've used a slightly jokey name for this investing tribe, but the fact is their flaws were very human. I went over all their investments, and it broke down into 10 key factors, a range of biases and influences to which every investor is more or less prone, but which the rabbits failed to control or circumvent through better habits. By giving in to these factors, they too often ended up caught in the headlights, the results of which were never pretty. 1. Unfashionable insects. One of the most important influences on the rabbits is what I call NAF. B, or narrative fallacy framing bias. I have to admit that every time I think of this term my mind conjures up an image of an insect with poor fashion sense, but it's actually a very important concept. It is a condition that was alluded to in 1974 by two brilliant Israeli academics, Amos Tversky and his Nobel Prize-winning collaborator Daniel Kahneman. 3. Their ideas will crop up throughout these points. Tversky and Kahneman suggested that people's decision-making is influenced by a cognitive condition they referred to as a framing bias or anchoring heuristic. In other words, when people make decisions they tend to reach a conclusion based on the way a problem has been presented. One of the rabbit's mistakes was allowing their favorite types of investment to dominate how they looked at a stock. The rabbit that invested in Vike loved blue sky stocks, and because he was looking for shares that might be the big next thing, that's what he saw when a stock gave him half the chance. Not FFB also goes one step further than this and suggests that we can make up stories to positively explain losing situations. Look at the following figure. Which company's shares would you buy? Based on this chart? The price charts you see are actually not only for the same stock, they even end at the exact same point. All that's different is the time frame and how we think about the stock as a result. One time frame makes you believe the stock is a winner to be snapped up as soon as possible. The other makes you think it is a loser to be shunned. Both cannot be true at the same time. Whenever the rabbits found themselves in a losing position, not FFB tended to kick in and made them think, okay, I have lost money, but my thesis, the story as to why I have invested, is not broken. The share price will turn around and I will still make a lot of money from here. They were capable of constantly adjusting their mental story and time frame so that the stock always looked attractive. The rabbits are a great example of how professional investors often react to a black swan event, an event they did not anticipate and which has negatively impacted their investment story. They tend to dismiss it. There were problems at Vike, serious ones, as it turned out. By 2011, the firm was delisted. Soon after, it went bust. The investor was lucky to get out at all. 2. I'm in love. Primacy error was another issue. This describes the way that first impressions have a lasting and disproportional effect on a person. A classic example of primacy error in real life is love at first sight. It is also demonstrated by newly hatched ducklings. The first living thing they see immediately after hatching they take to be their mother. Thus, if the first thing they see after hatching is you, you will soon have a line of loyal ducklings following you wherever you go. With the rabbits, first impressions were often everything. The investor who bought into Vostok had taken a view of the firm some time ago and simply failed to update it to match reality. The net result was that they underreacted when they found themselves losing money. Scientists who fall deeply in love with their hypothesis are proportionally unwilling to take no as an experimental answer. Michael Brooks. I'm afraid that misanthropic investors cannot rejoice at this point, if that idea is not a contradiction in terms it is perfectly possibly for the opposite of love to be an issue. Stuart Sutherland in his book Irrationality talks about the halo effect and the devil effect. If the first time we are introduced to an investing idea we look at a price chart and see that it has consistently declined for the past 10 years, we are likely to classify it as a baddie, a dog as the investment pros would call it. Thereafter this taints our view even when the underlying facts might have changed profoundly for the better. So there can be perfectly good companies shunned for no good reason. Committed value. Investors will not find this too surprising. 3. Anchor away. A closely related cognitive bias to primacy error is anchoring, dropping our intellectual anchor and letting it sink deep into a view and being unwilling to accept new findings that suggest we are wrong and should haul it up and sail the hell out of there. If a rabbit did eventually change his mind, it was always an achingly slow process. It took one rabbit 2.5 years to change his mind on Vike, and another rabbit almost 2 years to react to Raymarin's decline. The other never changed his mind on Vostok. Similar stubbornness occurred on many other investments. Interestingly, in the investment world, anchoring explains why an earnings surprise typically follows prior surprises. analysts tend to slowly adjust earnings numbers for a company in their models. No one likes to acknowledge they are wrong, especially if the change requires a complete about turn. As such, change tends to be a slow process of gradual adjustment. Surprise after surprise. 4. Too soon? Imagine a scenario where you buy a bar of gold for £1,000. The next day I offer you £500 for that bar. Would you sell it to me? I think most people wouldn't. Would your response change if I opened the newspaper and showed you that the price of gold had crashed overnight and to sell your bar on the open market would only get you £250? You probably still wouldn't, and the same would be true of most people. You are anchoring to the £1,000 you paid yesterday. Moreover, you have a vested interest. You own the gold bar, so you believe the bar to be worth more than the price being offered. This is known as endowment bias. If I asked you to name your price for that bar of gold, what would it be? I suspect it would be at least £1,000, given that is your anchor value, the price you paid. My own experience of managing a team of investors is that large losses that happen over a short duration are almost impossible to accept, especially when they are substantial. It's easier to hold on to a losing position than realize the loss by selling up. Not least because people believe it to be Sod's law that the price will bounce back post-sale. The rabbits could not bear the idea of crystallizing a loss. They were too aware of how much they had paid for those losing shares. I want you to now imagine that you have held the gold bar for 10 years. Chances are you cannot remember the price you paid for it all those years ago, and I suspect you would be more likely to sell it to me for £500. It would be an easy decision because you would be far less conscious of the anchor value. In addition, I am offering you twice as much as you would receive on the open market, so this would appear to be a good deal. 5. The pull of the crowd. I might be singling the rabbits out for the money they lost me over the years, but the fact is they were rarely unique in the investments they made. Sadly, that was just another reason why they tended to persist with their mistakes. Neuroscientists have shown that when we don't conform, the amygdala, the part of brain associated with fear, lights up. Going against the crowd makes an investor nervous. Few investors are willing to be a lone voice for fear of others ridiculing them. And many investors got burnt on the same investments as the rabbits. Sadly, the same trait of conforming to peer pressure is why most investors only invest at the end of a bull run. No one wants to be seen as the fool who stood on the side while his neighbors and friends were making vast fortunes. As a fund manager, I can testify that the inner mental pressure to invest in stocks that you do not hold and that are going up is immense. Furthermore, you have to constantly fight the urge to sell stocks that are hurting you. Feelings of pleasure, pain, and fear go a long way to explaining investor actions and omissions. It is the long-term investor who will in practice come in for most criticism. If in the short run he is unsuccessful, which is very likely, he will not receive much mercy. Worldly wisdom teaches that it is better for reputation to fail conventionally than to succeed 5. Unconventionally. John Maynard Keynes. 6. Ego. The rabbits really didn't like being wrong. They were, in fact, ultimately more interested in being right than making money. Many professional investors I know are, deep down, the same. Whenever a rabbit defended a losing investment, it reminded me of Warren Buffett's famous saying, "Forecasts tell you little about the future but a lot about the forecaster." The rabbits all carried false passports. They actually originated from that fictitious country that Nassim Taleb calls Extremistan. They were never going to accept their views were wrong. The fact is, the greatest minds on the planet can be wrong. My findings suggest you should expect to be wrong at least half of the time. The very best investment minds are. 7. It's not my fault. Behavioral psychologists have a term for when we blame others or external factors for our misfortunes but take full credit when things go well. They call it self-attribution bias. It is one of the key reasons we don't learn from past mistakes but keep repeating them. It never ceased to amaze me how many times the same two villains popped up in the stories told by rabbits harboring a losing position, Mr. Market. The market is being stupid, and his sidekick Mr. Unlucky, it wasn't my fault, I was unlucky because of XYZ that no one could have foreseen. The rabbits were not only good at blaming these two foes. With Ray Marine, one of them was even able to blame illiquidity, a real but entirely optional villain no serious investor should ever encounter, for his inaction. 8. The wrong information. Related to the problems of ego and self-attribution bias, whenever a rabbit was losing, you could always guarantee that he or she would go on a mission to seek out more information to help make the right decision. Unfortunately, undertaking additional research is not as good an idea as it may first appear. For example, if the additional research is carried out by the very same analyst who recommended the stock, as it often is in the city and on Wall Street, naturally his or her focus will be on finding reasons to support the original recommendation. No one wants to admit they were wrong. Moreover, the analyst will probably be someone the fund manager likes and respects, which means the manager will not be inclined to challenge his or her view. When you consider all the variables and assumptions that analysts have to deal with before they reach a conclusion, it is mind-blowing that they could have any degree of confidence at all. Because many of the rabbits had been professionally investing for a couple of decades, controlling a significant amount of assets, they had Rolodexes to die for. When they found the story behind an investment being challenged, they liked nothing better than picking up the phone and dialing the CEO on his or her personal number to get to the bottom of things. Despite being reassured by the CEO that the setback was merely a bump in the road and the media was making a mountain out of a molehill, the rabbits would do nothing. They neither bought more shares nor sold their holdings. A hugely appealing temptation for more information comes from the need to abrogate responsibility in times of crisis. It is very common when a difficult decision has to be made to see the decision maker involving more people. The more people involved, the more they can relax because if it goes wrong, it was not their fault. In companies, the unwillingness of board members to make big decisions that may have far-reaching consequences is the reason financial consultants exist. Boards tend to heavily rely on external advisors when making such decisions. Various studies focused on betting have shown that while more information increases a person's confidence, it does not increase their accuracy, success ratio. Sometimes I have to tell myself to not focus on the math. The danger with the math is that it can make you think you know more than you do. Instead of thinking about what the other player is doing, you end up obsessing over the percentages. 6. Johann Lehrer. 9. Too big to fail. Like many managers, the rabbits were less inclined to walk away from a large losing investment than a small losing investment. The denomination effect. 7. Described by Himanshu Mishra, Arul Mishra, and Dhananjay Nayukan Kapam and Priya Raghubir and Joydeep Srivastava. This phenomenon 8 helps explain. Their research showed we find it easier to spend money if we have small denomination coins than when we have larger banknotes. The bigger the losing positions, the more nervous and indecisive most of us become. This can be more of a problem if you have a smaller portfolio. The Investors I worked with readily admitted that in their funds, some of which held up to 100 stocks, it was far easier to sell a losing position because it represented only 1% of the overall fund's net asset value. Thus, if the stock was down 40%, it had only cost them 0.4%. Whereas with the money they managed for me, that stock was perhaps one of only 10 positions, each position being on average 10%. As a consequence, to sell meant realizing a 4% loss on the total assets managed. 10. I am due a win. Investors like the rabbits typically suffer from a dose of gambler's fallacy. This is the mistaken belief that the odds for a stock have become more attractive due to recent poor performance. It's the belief that you will win after a streak of losses playing roulette at the casino. I am due a win. Even where the odds are 50-50, like the toss of a coin, a deluded gambler believes the odds change in his favor the longer he stays in the game while on a losing streak. The fact is, the probability of a fair coin turning up heads is always 50%. Each coin flip is an independent event and all previous flips have no effect on future coin tosses. What the rabbits could have done differently. The bad news is, everyone can be a rabbit. The good news is, no one needs to be. There are a few simple things they could have done to overcome their problems. 1. Always have a plan. Investing is all about probabilities. Whether you invest should depend on the odds and the edge you think you have. Given the odds and your edge, you should know exactly what you are going to do if the stock you are investing in falls or rises by 20%, 50%, and so on. When faced with a painful loss-making position, most people do nothing. They turn into a rabbit and procrastinate, letting all their biases play havoc with their decision-making, hoping time will resolve their issues so they don't have to. The best way around this is to draw up a plan of precisely what actions you will take when your investments don't work. The rabbits didn't have one. You can. The necessary actions in a plan are really quite simple. As the next point explains, it all comes down to two choices. 2. Sell or buy more. When you hold a stock that is losing, you feel terrible. You beat yourself up and wish you could turn back the clock. You find yourself unable to sleep. Some people turn to religion and pray for divine intervention. Dear God, if you make the share price go back to the price I paid so that I can get out and not lose money, I will be a good investor in the future. I am not asking to make money or be greedy. I admit that I have done this on more than one occasion in the past. Sadly, it didn't help. The only solution to a losing situation is to sell out or significantly increase your stake. You have to materially adapt if you hope to survive and prosper. If a stock price is down after your investment, the market is telling you that you were wrong. If you really do believe you were right to invest in that company, then you were clearly wrong in the timing. The sooner you acknowledge you have made a mistake and take steps to deal with it, the better your odds of achieving a successful outcome. Ask yourself the key question I now ask all of my investors. If I had a blank piece of paper and were looking to invest today, would I buy into that stock given what I now know? If your answer to the question above is no, or maybe, but, then you should sell. If you conclude that you would not buy the shares today but find that you cannot push the sell button, be aware that this is because of endowment bias and not a logical investment thesis. Sell. Legendary investor Peter Lynch adopted a similar approach. Very few months I checked the story just as if I were hearing it for the first time. And I would get out of situations where the fundamentals are worse and the price had increased, and into situations where the fundamentals are better but the price is down. A price stop is any opportunity to load up on bargains from among your worst performers. If you can't convince yourself when I'm down 25% I'm a buyer, then you'll never make a decent profit in stocks. 9. Doing nothing when you are losing is never an option, because if the stock price rises from here, you should have put more money to work. If it falls further, you should have cut your position. The rabbits weren't terrible investors just because they refused to accept they were wrong. The real giveaway was that they refused to do anything when they found themselves in a losing situation. Data point: losers stay losers because they fail to materially adapt. Out of 941 investments that lost money when measured from the moment the investor bought the stock to the moment they sold, only 32.3% made money thanks to the trading activity of the managers. Whilst they were invested, by trading activity I mean buying shares in that company after the initial purchase and before the final sale. It is important to realize that many of these losing investments could have been profitable had the investor materially adapted, having concluded they were sticking with that investment. Only a select few investors have the courage to make key changes, even though the benefits of doing so are unmistakable, as we'll see, particularly in Chapter 3. Nowadays, I start to apply pressure on my managers when a stock is down over 20% to ensure action is taken before irreparable damage occurs. I have learnt that I cannot trust great investors to do the right thing when they are losing. Like top athletes, they require coaching and management. 3. Don't go all in. A corollary of the previous point is to never put yourself in a position where you find you are still convinced by your original investment idea but are not able to invest more money when the share price falls. That is poor money management. Keep some powder dry. This also helps neutralize the denomination type of effect of feeling an investment is too big to be changed. In my own portfolios at Pabrai funds, I adjust for this, getting the odds wrong, by simply placing bets at 10% of assets for each bet. It is suboptimal, but it takes care of the bet 6 being superior to bet 2 problem. Many times the bottom 3 to 4 bets outperform the ones I felt the best about. 10. Monish Pabrai. Action may not always bring happiness, but there is no happiness without action. Benjamin Disraeli. 4. Don't be hasty to jump in, do be hasty to jump out. We should all remember the following wise words: it is easier to get into something than to get out of it. 11. Ned Davis, in his book Being Right or Making Money, using the Dow Jones Industrial Average from 1929 to 1998, showed that the bulk of investors' losses in bear markets come in the final third of the fall. 12. This suggests that cutting your losers early is difficult, but makes a lot of sense. Not least because selling out of a stock helps clear your head and enables you to assess a situation more objectively. It's like taking a decongestion pill when suffering from a cold. And buying slowly over time, known as dollar or pound cost averaging, with a reduced position size at the outset, ensures you have plenty of ammunition left to load up when a share finally capitulates, assuming it does. Hat separates the winners from the losers? The answer is simple: the winners make small mistakes while the losers make big mistakes. 13. 5. Remember, there is a difference between being right and making money. Even if you are convinced you are right, remember the saying, there is nothing like an idea whose time has come. In investing, a lot of success can be attributed to being in the right place at the right time, otherwise known as luck. A classic example of this is Laker Airways, which was founded in 1966 by Sir Freddie Laker. In 1977, this firm introduced the world's first budget airline and operated low-cost flights between London Gatwick Airport and John F. Kennedy Airport in New York. Due to a combination of recession, high oil prices, changes in currency, and simply being ahead of its time, it went bankrupt in 1982. Contrast this with today, when there are many airlines successfully operating low-cost, low-frills flights, the most well-known being Ryanair and EasyJet in Europe. 6. Seek out opposition. When people lose money, they don't want to be told they are wrong. They want reassurance, the same way people sometimes visit a doctor to be told everything is fine. What you should really do is to speak to someone with an opposing view. Ideally, you should also sell out of the stock while you do that, so that you have removed the emotional attachment of a vested interest. This mitigates endowment bias, and you can always buy the stock back later. If you would not put money to work in a particular share today, knowing what you now know, then you have to concede that the investment is dead. And if you haven't already sold, you absolutely should now. 7. Be humble. As you can imagine, the rabbits, like many investors, were incredibly smart. Many of them had MBAs, CFAs, and other letters after their name. That suggested they had an analytical advantage over the rest of the market. The rabbits were often very confident. And they could be compelling. They never said, "I don't know." But this is a very dangerous mindset to have. First, it assumes the market is made up of buyers and sellers that are not equally expert, when in fact many will be. Second, knowing more often leads to a person not seeing the wood for the trees. Throughout history, there have been many examples that demonstrate this. My favorites are Harry Warner, of Warner Brothers, who in 1927 said, "Who the hell wants to hear actors talk?" and Thomas Watson, chairman of IBM, who in 1943 said, "I think there is a world market for maybe 5 computers." Experts are surprisingly bad at forecasting. Falling for your own hype can also often lead to mistakes that the least intelligent person in the world would not be capable of. Warren Buffett, when talking about the collapse of long-term capital management, marveled at 10 or 15 guys with an average IQ of maybe 170 getting themselves into a position where they can lose all their money. 14. And crowds are often surprisingly wise. The market can be right even when everyone who makes it up is individually wrong. In 1987, Jack Traynor presented 56 of his students with a jar full of jelly beans and asked them a simple question. How many jelly beans were in the jar? There were 850, but not one student got it right, hardly surprising. What is more surprising is that despite the guesses varying massively from one student to the next, the average number taken from all those wrong numbers was only 2.5% off the actual number of 850. Only one student guessed a number closer to the actual number than the average. Michael Mauboussin repeated this experiment in 2007 with 73 of his Columbia Business School students, and his findings corroborated Traynor's 15, while the actual number of jelly beans in the jar was 1,116 and the guesses ranged from 250 to 4,100. The average guess from all these wrong guesses was 1,151. That's just 3% off the mark, and only 2 students gave guesses that were closer to the real number of beans than the average of all the wrong guesses. Remember this the next time you pound the table shouting, "I am right and the market is wrong." My findings show that, on average, only 49% of great ideas make money. If that doesn't scare you, then consider this. Another study found that fund managers who were 100% confident in picking winning stocks over the next 12 months were right even less, only 12% of the time. 16. You should expect your ideas to be wrong and invest with that in mind. 8. Keep quiet and carry on. Be careful who you talk to about your investments and how you talk about them. Some people have an almost religious zeal for shares they have bought, and like nothing better than sharing their views in public to as many people as possible. Unfortunately, this makes it impossible to walk away from an idea without Looking like an idiot. It's an unnecessary hindrance. The rabbits might have been less likely to get stuck had they not boasted of anticipated returns. Among all forms of mistake, prophecy is the most gratuitous. George Eliot, Middlemarch. Reflexivity, why the future is never certain. George Soros's reflexivity theory suggests that markets cannot possibly discount the future correctly because they do not merely discount the future, they also help to shape it. Reflexivity is, in effect, a two-way feedback mechanism in which reality helps shape the participants' thinking and the participants' thinking helps shape reality in an unending process. As such, we should be anything but dogmatic in our views. 9. Don't underestimate the downside, adapt to it. Many of the rabbits who worked for me loved stocks that could shoot for the moon. They were stocks that had massive potential upside if the story played out. It was no wonder they were keen to jump in. Unfortunately, unlike financial options, which have a limited loss, the premium paid, these stocks do have a downside, and it can be large. The prospect of huge profits tends to make the possibility of losses dwindle, but that possibility is always very much alive. The solution is simple: treat them as if they are options. Invest an amount you are willing to lose in the same way that you would pay a one-off lump sum, called a premium, to purchase a stock option. This represents the maximum amount of money you can lose if the option contract closes out of the money. If the stock does go bang as opposed to pop, then the amount you have lost is not fatal. 10. Be open to different kinds of story. Many studies have shown that stocks with the worst stories tend to produce the highest returns. Stated differently, value investing, investing in cheap stocks that no one likes because they have terrible stories that led to their stock price falling, produce the highest returns over time. While I am not advocating the avoidance of what I call magnet stocks, or glamour stocks, remember that there are lots of different stories out there. 11. Get sick of sick notes. Over the years I heard many wonderful explanations as to why the rabbits got things wrong. I always found them amusing. That said, no one likes admitting they are wrong, especially if we have to report to a boss and explain our actions. Instead of coming up with increasingly fanciful explanations of why an investment hasn't yet come right, I would urge you to use this tendency to your advantage and do the opposite: familiarize yourself with all the well worn excuses in advance so that you waste no time trying to fool yourself or anyone else into persisting with a mistake. Here are some of the excuses I have heard over the years. A. The if only defense. B. The I would have been right but for defense. C. The it just hasn't happened yet defense. D. The who could have foreseen at the time I invested that XYZ would happen defense. Peter Lynch in his book One Up on Wall Street lists the 12 silliest and most dangerous things people say about stock prices. Some of these are well worth including here too. E. If it's gone down this much already, it can't go much lower. F. You can always tell when a stock hits rock bottom. G. Eventually they always come back. H. When it rebounds slightly, I'll sell. Having this list of excuses to hand is very beneficial. Check it when you are losing. Are you making any of these excuses to justify not selling? 12. Be suspicious of status. Lastly, whether you work in the investment industry or are thinking about trusting your money to someone who does, there is a bonus moral in the story of the rabbits. It is dangerous to assume that just because an investment professional is highly educated and has years of experience, he or she will be good at making money and getting the big calls right. It's all about capital impairment. One of the reasons that the rabbits held on to losing investments was fear of the unknown. If they sold out, the shares might rally, and they would miss out. It was better to stick with the current loss than worry about that. Double whammy. This is known as ambiguity aversion, and describes why people prefer to stick with intolerable situations merely because a hypothetical alternative might be worse. Better the devil you know. When it comes to losing investments, the facts basically never justify this. And the rabbits should have used this to fortify themselves against inaction. Here's an example of a rabbit investment showing how wrong this thinking is. Case study, Titan Europe. Titan Europe is an engineering company that designs and manufactures wheels and undercarriage components for off-road vehicles used in the agricultural, construction and mining industries. It boasts manufacturing and distribution centers in countries as far afield as the USA, Brazil, China and Japan. Its shares went up a staggering 307% after one of my investors sold them on December 5, 2008. This fact alone would be enough to make any investor feel angry, but that is not the point. In this case, the investor had lost 95% during the previous 2 years when he held them, and the fact is, even if he had chosen to stay invested, he would still have made a loss on the overall investment of 82%. The only chance to redeem the situation would have been to sell all his other investments and put all the money into the stock when it was down 95%, thus lowering his book price enough to allow him to get his losses back. The problem with that as a strategy is that it is the equivalent of going to the casino and betting everything on black. It either works or it does not. The outcome is binary. To make money, you need to have money. In other words, to maximize profits, you have to minimize losses. You must preserve your capital. When you are losing, you have to materially adapt to mitigate the situation, as you will see when we come to the assassins and the hunters. Permanent impairment of capital destroys wealth. Data point: destroying wealth. My analysis of the 946 investments that lost money, bad buys, revealed that 19 investments, accounting for just 2% of the overall bad buys, lost more than 80%. 131 of those investments, 14% of the bad buys, lost more than 40%. This tells me that the majority of professional investors I worked with appreciated the dangers of losing too much capital. It doesn't take much to permanently destroy wealth, just being indulgent with one or two losing investments. When you have lost this much money, it takes extraordinarily large returns to make up the lost capital, let alone turn a profit and make money. Here is one final notable example of this in a rabbit investment. Case study, Cape. I have saved the best case study to last. Make sure you are sitting down and don't have a hot drink in your hand before reading on. One of my investors bought shares in Cape on September 28, 2007 for £2.79 per share. Cape is considered a global leader in the provision of essential services for the energy and natural resources sectors, ranging from industrial cleaning to painting and coating. It has operations throughout Europe, Africa, and Asia. Unfortunately for this investor, a black swan hit in 2008 in the form of the global financial crisis. This led to cyclical companies with debt on their balance sheets being sold off. Cape, being a company with a small market capitalization, suffered as investors headed for the doors, and lack of liquidity compounded the problem. He eventually sold on March 10, 2009, with the share price standing at just 18 pence per share, representing a loss of 94%. That loss is not the most startling aspect to this story. Nor is the fact that once it was clear the world would survive the crisis, Cape's share price rebounded and went up an eye-watering 1,129%. The most shocking aspect of this story is that even if he had stayed invested and enjoyed the rebound in the share price, he would still have lost 32%. Unfortunately, large stock market returns are rare, even if you can hold your nerve and not sell out of one too soon. If you stick with a big loser and do nothing, you are virtually guaranteed to be permanently destroying your wealth by creating a hole that is simply too deep to dig your way out of. I believe that even the best investors often overlook the fact that a stock's price would need a practically supernatural rise of 900% to break even if they have foolishly ridden it down 90% and done nothing. Losing 50% means you need a return of 100% to break even. Clearly, most of my team knew the danger of suffering big losses and took action before irreparable damage was caused. This is shown by how few large losses we experienced. Overall, we avoided permanently impairing our capital. The remaining chapters show how. Data point: bye-bye break-even. For those of you who are curious to know whether the rabbits recovered their money from staying invested in their big losers, let me satisfy your curiosity. Of 131 investments that fell by more than 40%, only 21 went on to produce returns of over 100%. Odds of 1/6 are not great. And not one produced the required returns to get back to break even. The lessons of poker. Stories are the biggest factor in determining what decisions we make. 4. The rabbits, the stories in their heads led them to invest many millions in companies that ultimately lost them and me vast amounts of money. Their actions post-investment were clouded by the story that led them to invest on day one. The moral here is to try to avoid being blinded by your story. Above all, have a plan of action as to what you will do if you find yourself in a losing position, even if you still think you are right. Nothing proceeded exactly as planned. Yet we managed to construct that docking module anyway. 17 Astronaut Colonel Chris Hadfield, referring to his first mission where the objective was to construct a docking module on the Russian space station Mir. The key difference between the rabbits and successful investors in this book is that when the rabbits were losing they did nothing. As we will see. With the assassins and hunters, they acted decisively to bail themselves out of the holes they found themselves in. It is not the strongest of the species that survive, nor the most intelligent, but the one most responsive to change. Charles Darwin. If only the rabbits had played poker. Any poker player knows that it is not how many hands you win that matters, it's how much you win when you win, and how much you lose when you lose. Each hand in poker represents a story, and the goal for a poker player is to try to make money with whatever story they have been given, good or bad. If the story is poor, then you don't stick with it and throw money at the problem. The odds are stacked against you. You fold your hand, cut your losses, and live to fight another day. Likewise, if you are dealt a good hand but then see the flop and realize the hand is now nowhere near as strong as you thought, you fold. Billionaire investor Jim Rogers was once quoted as saying, "My basic advice is don't lose money." 18 He should know. This is the end of the chapter 1. The rabbits, caught in the capital impairment.